So when I bought my first rental property, not only did I buy it with no money down, I actually got paid to buy the property. Most people think that it's impossible, but it's not. And today, I'm going to show you exactly how I did it, and more importantly, how you can buy a property with little to no money down, even in today's economy. All right, so I'm Ernest, and I started working as a housekeeper, a cook, and in retail making $8 an hour. I eventually joined the Air Force, where I discovered personal finance and real estate. And since then, I've built a multi-million-dollar rental portfolio, not because I had money, but because I learned how to use the system the right way. And with interest rates around 6%, home prices cooling in some markets, and affordability at 30-year lows, understanding how to buy with low or no money down is more important than ever. So let's break down the exact steps. So most people think that you need 20% down to buy a property. But in reality, most home buyers use loans that only require you to pay 0 to 5% in down payment. So yes, you do need to live in the property for a year. But think about it. You have to live somewhere, right? So why not live in a place that also builds equity, generates cash flow, and sets you up for the future? And believe me, that 1 year goes by fast, but the benefits last for decades. So let's go ahead and look at the 4 loan products you can use to get into the game faster. And the first one, which is what I personally used, is the VA loan. If you're active duty military, a veteran, or an eligible spouse, this is hands down the best loan in the country. This loan doesn't require private mortgage insurance or PMI, and the credit requirements are way more flexible, usually around the mid 500s to low 600s. Then there's the FHA loan, which is the classic first-time home buyer loan. It's a 3.5% down, and the credit score requirement is usually around 580 or higher. And they're pretty flexible with debt-to-income ratios. The trade-off here is you'll pay mortgage insurance, but it makes qualifying much easier. You can also use conventional loans, which for first-time home buyers can be as low as 5% down. These are great if you have a stronger credit profile. The PMI eventually falls off, and it's a solid long-term loan structure. And finally, you've got the USDA loan. A lot of people don't even know that this one exists. It's also a true zero-down loan, but it's meant for rural areas and some outer suburbs. There are income limits, but if you're buying just outside a big city, this can be a huge opportunity. So what's amazing about the VA, FHA, and conventional loan is that you can actually buy up to 4 units. And that's a big deal, because buying a duplex, triplex, or fourplex lets you live in 1 unit and have the other units help to pay for your mortgage. And that's exactly how so many first-time home buyers build wealth without starting with a lot of cash. So when people say you need 20% down, that is just not true. These 4 options are how regular people buy their first home every single day. Okay, so these loans reduce your down payment, but you still have closing costs. To actually walk in with $0 or even get paid at closing, you need to understand the closing credits of the equation. And that's the part nobody talks about. Okay, so there are 3 things you need to keep in mind if you want to buy a property with as little money down as possible or even get paid to buy it. The first one is something called seller credits. And today, this is way more common than people realize. If a house has been sitting on the market for 30 days or more, sellers start getting flexible. They'll offer credits to cover your closing costs, credits for repairs, or even credits to help buy down your interest rates. And sometimes, if the home is a little outdated, they'll even throw in concessions just to get the deal done. All of these credits go straight toward reducing how much you owe at closing. The second is prorated rents. And this is one of the coolest parts of buying a multifamily with tenants already living there. If you make sure to set your closing date early in the month, the seller actually owes you rent for the days you own the property. So say, for example, if rent is $1,500 a month and you close on the 3rd day of the month, you own the property for the last 27 days, which means the seller has to give you a credit of about $1,350. So if you buy a 4-unit apartment building and you intend to live in 1 unit, you actually can multiply that $1,350 times 3, which comes out to $4,050. Now that's massive. So when you make an offer, make sure to let your agent know that you close early in the month. It's not something that you need to ask the seller for. It's automatic and it shows up right in your closing statement. And the third piece, which is most people forget about, are the security deposits. When you buy a rental property, those deposits legally transfer to you. If there are 3 tenants who each put down $1,500 in deposit, that's $4,500 that gets credited to you at closing. The caveat here is that since these are deposits, you need to give all or a portion of it back to the tenants when they move out. But again, that is something that you only need to do when they move out. So let me show you how all this comes together. All right, so say for example, your closing costs are $6,000 and the seller gives you $3,000 in credits. You get about $4,050 in prorated rents and you receive $4,500 in security deposits. Your closing balance goes from you having to pay $6,000 to you actually receiving $5,550. So if you buy a property worth $500,000 using the VA or USDA loan, you'll literally receive $5,550. And in that case, instead of paying money to buy the property, you actually get paid to buy it. Or if you buy the same $500,000 property using FHA loan with 3.5% down, which is $17,500, and you receive $5,550 in credits, you only need to pay $11,950, or call it 12 grand at closing. Yeah, you may not actually get paid to buy the property using the FHA loan, but think about it. You only need $12,000 to buy a $500,000 asset. And that is mind-blowing. Here's exactly what happened with my property. So back in 2019, I bought a 4-unit apartment building for $240,000 using a VA loan. And 3 units have tenants in them. So when I purchased the property, I got prorated rents, I received all the deposits, and I negotiated seller credits. Since it's a VA loan that required little to no money down, all those things added up to the point where my closing statement showed a positive balance. So instead of paying money to close, I received a check of about $2,500. I lived in 1 unit for a year, which allowed me to live in the apartment for free while owning the building. And after 1 year, I did it again and bought a duplex for $200,000. So if you add those 2 properties up, I was able to buy $440,000 worth of property with 0% down. It wasn't glamorous. I did a lot of things myself. I did my own lawn care, fixed things myself, learned how to manage tenants, but those properties served as my training wheels and gave me the foundation to start scaling. And I still own both of those properties today. So if you're wondering how to do this today, here's the blueprint. And honestly, it's a lot simpler than you think. The first step is choosing the right loan. If you qualify for VA or USDA, great. Those are the true zero down options. They're the best deals in the country if you can use them. If you don't qualify, then the FHA at 3.5% down or conventional loans are perfectly solid ways to get in. The loan you choose is basically the tool you bring to the deal. The second piece is the type of property you go after. This strategy works best with duplexes, triplexes, and fourplexes. And there's a reason for that. You inherit the tenant's deposits and rent, and the rental income makes it easier to qualify. And that's why most of the people who get into real estate with low money down start with small multifamily. It's the most efficient path. Next, you want to focus on motivated sellers, not distressed sellers. Just people who are realistic. Look for homes that have been sitting on the market for 30 days or more, properties with recent price cuts, or listings that say that the seller is open to concessions. Those are the deals where you can negotiate the credits that make the no money down structure work. And once you line all that up, you run the numbers. I literally look at it like an equation. Credits, prorated rents, security deposits, minus down payment, minus closing costs, equals cash needed at closing. If that number hits 0, you can buy the property with no money down. And if it goes negative, you actually get paid at closing. Alright, so yeah, there you go. Buying a home with no money down isn't magic. It's a combination of understanding loan products, negotiating credits, and choosing the right type of property. I bought my first property with no money down, and it literally changed the trajectory of my life. And real quick, if you want help building your own simple wealth system, or you want someone to guide you step by step so you don't waste years figuring this out alone, I do offer one-on-one coaching. I'll put the link in the description below if you want to see what that looks like. Alright, so if this helped, make sure to like and subscribe. I'll create videos that help people build wealth and achieve financial freedom. And your journey to financial freedom starts right here.